What if I told you that some of the greatest investment opportunities don't appear when everyone is excited, but when almost everyone is afraid? It sounds backward, yet history has shown this pattern again and again. While most investors chase what's popular, the truly exceptional ones often look in the opposite direction, and few people have explained this better than Howard Marks. Howard Marks is the co-founder of Oaktree Capital Management and one of the most respected voices in value investing. His investment memos are studied by professionals around the world, not because he predicts the future, but because he teaches people how to think. One idea appears repeatedly throughout his work. Successful investing isn't about following the crowd. It's about thinking differently when you have good reasons to do so. This is what contrarian thinking is all about. Now, contrary to what many people believe, being contrarian doesn't mean disagreeing with everyone just to be different. Howard Marks has warned against that misconception many times. Simply taking the opposite side of the crowd isn't a strategy. The goal isn't to be different. The goal is to be right. Think about it this way. Imagine you're standing in a busy shopping mall where everyone rushes toward the same store because a sign says limited time offer. Most people never stop to ask a simple question. Is it actually a good deal? Investing often works the same way. Excitement spreads quickly, fear spreads even faster, and people begin copying one another instead of thinking independently. Howard Marks believes markets are driven as much by human psychology as they are by company fundamentals. When optimism becomes extreme, investors start believing prices can only go higher. They ignore risks, overpay for assets, and convince themselves that this time is different. But eventually, reality catches up. The opposite happens during market crashes. Fear takes over. Investors rush to sell quality assets simply because everyone else is selling. Prices fall, sometimes far below their true value. While the crowd sees disaster, the disciplined contrarian sees opportunity. One of the clearest examples came during the 2008 global financial crisis. Panic spread across financial markets. Investors dumped stocks, real estate, and corporate debt with little regard for long-term value. It was one of the darkest periods in modern investing. Yet investors who carefully evaluated businesses instead of following emotions found extraordinary opportunities. Companies with solid fundamentals were trading at prices few thought possible. Those who stayed rational while others panicked were rewarded over the following years. Howard Marks often reminds investors that the biggest mistakes happen at emotional extremes. When everyone feels invincible, caution is valuable. When everyone feels hopeless, courage becomes valuable. This doesn't mean buying every falling stock or ignoring real risks. It means separating temporary emotion from lasting value. Another concept Marks frequently discusses is second-level thinking. First-level thinking is simple. It sounds like this. This company is great, so I'll buy the stock. Second-level thinking goes much deeper. It asks, everyone already knows this company is great. Is that greatness already reflected in today's price? What expectations are built into the market? What is everyone else missing? That extra layer of thinking often makes the difference between average investors and exceptional ones. Of course, contrarian thinking isn't easy. Human beings naturally seek comfort in numbers. Following the crowd feels safe because if everyone makes the same mistake, it doesn't feel like a mistake at all. Standing alone feels uncomfortable, even when the evidence supports your decision. Howard Marks argues that this emotional challenge is precisely why genuine opportunities continue to exist. If independent thinking were easy, everyone would do it, and the advantage would disappear. So how can you apply this mindset in your own investing journey? Start by questioning popular narratives instead of automatically accepting them. Learn to recognize when emotions are driving market behavior. Develop patience because the market rarely rewards impulsive decisions. Focus on managing risk before chasing returns. And most importantly, remember that successful investing isn't about proving you're smarter than everyone else. It's about making thoughtful decisions based on evidence rather than emotion. Howard Marks doesn't encourage investors to predict the future. Instead, he encourages them to understand cycles, control emotions, and think independently. That's a lesson that remains valuable whether markets are soaring or falling. The next time you hear that everyone is buying a particular investment or that everyone is running away from one, pause before joining the crowd. Ask yourself a simple question. Is this opportunity being driven by facts or by emotion? That single question could transform the way you invest, because in the world of investing, the crowd is often loud, but wisdom is usually quiet.